Welcome back. This is Chart Overload. This is beginning April. I am Ryan Mumy, the CEO of Celinda Capital Management. That's Justin Greenhill, our Chief Investment Officer, and together we founded Celinda Capital Management. We bring you these, every couple of weeks, run through the charts, things that are interesting to us. Hopefully you take something away from it that you find interesting. Things we think maybe the headline news isn't covering. But Justin, if you're ready, let's fire it up.
I am ready.
First chart looking in the big picture. First chart looks at crude oil, 2-10 30-year treasuries, and the 7-year SOFR, adjustable rate mortgage rate. Looking at it from February to March, what we see here is big moves. Yes.
Yeah.
Big moves.
Oil, everything is, what did someone say here recently? Every market is oil at this point.
Yeah, it matters.
In the near term, yeah. So shock in oil has sent interest rates quite a bit higher, which is interesting when you think about the fact that, the economy was already showing some signs of weakness, and the case for lower interest rates throughout the last period of time has been the fact that was needed to kind of comfort the economy. So now,
that was the crowded trade. Was the Fed's cutting? The Fed's cutting, and how many?
Last week.
Yeah, until last week.
Until it wasn't.
Next chart looks at the Iranian conflict, looking at the oil shock from a Fed funds rate, inflation rate, labor market tightness rate, as well as Brent crude prices.
Yeah, I think we really want to point out this chart in that look at all the other conditions on this chart, how different they were to start this oil shock. So even prior to what was a jump in oil based on geopolitics in 2022, you had the Fed funds rate was higher, you had the labor market a lot weaker, coming out of the pandemic, and most importantly, you had PCE inflation, which is, including things that are not oil pretty heavily. You had that much higher than it is now, which I think we might say, if one had to rationalize why the stock market is not freaking out yet, it's because of this, probably, right?
Yeah, there's more capacity to stomach it, right? And that plays in right into our next chart, looking at the average price of diesel and regular gasoline. And this is a big spike, right? This is where, everybody's talking about inflation and adjustments to yields. But at some point, depending on the time frame these stay elevated, it starts to impact demand, right? And that the demand destruction is what people talk about. And at what point we get there, we'll know it in hindsight.
I think one thing too to add to this is, similar to the stock market, a lot of the price of the oil market is sentiment, right? It's not as simple as like a clear answer on supply and demand. Otherwise, markets wouldn't move up and down a lot. Bearing that in mind, in 2022, the consensus across all global markets was that the oil market was tight, and that even before that happened, oil prices could go higher. Remember it went negative and then et cetera. Versus now, I think it's pretty much common knowledge, consensus at least, that it might take a few months, maybe a couple quarters, but if they can open the strait back up, there's no worry of a shortage in oil.
Yeah, plenty of supply, especially, with the Venezuela situation, even though we know it's going to take a while to possibly get that supply online. Again, grand scheme of things, everybody seems to be, which we'll talk about later, everybody could potentially be looking through this as, not to minimize it, but how many Middle Eastern bombing campaigns has the United States been a part of since September 11th, right? In the last 25 years, a lot. So we've almost desensitized to it, and the reaction function has as well. Next chart, you found this, really, really like this. Looks at U.S. credit priced as least risky assets. And that big line just means that U.S. credit has been priced as the least risky asset from a volatility standpoint as compared to equities and currency markets for a long period of time.
Historic, right? And I think
very.
There's a guy named Mike Green who was kind of the first guy who studied a lot in terms of passive flows. And since then, there's been there's just been an acknowledgement that it's a thing, right? And it's a huge thing versus it used to be somewhat controversial. Regardless, one would argue that this is because of passive flows. When people are contributing to 401ks and IRAs, they're basically buying the aggregate bond market or some proxy.
Meaning there's always some buyers there, regardless of the volatility, until it
And
reaches a
yeah,
point, but we
exactly. And
don't
in
know
the
what
case
that
of
point
credit,
is.
there's just not incentivized sellers nearly as frequently as there are in,
Yeah, and when we say credit, we're saying non-US Treasuries,
non-US,
right? Yeah.
domestically
So
issued non-US treasuries.
yeah, so that's a broad landscape, but I guess the counter to this, to the passive flows, is anomalies like this. We could call this an anomaly, rarely resolve sideways, right? At some point, there's going to be a snapback, and it most likely will be violent. But this has been a massive compression in credit volatility compared to the other markets. And as you said, it's either relentless, buying of aggregate bond index funds, or it's, severe market complacency to default risk, right? That companies can and do at times not have the ability to pay their bills, and or maybe it's somewhere in between. But
Well, it's
again,
back to the
I don't
oil
know that we're
market, right?
making a
I think we connect that back to our prior chart and we say, had we issued this chart on credit before the oil shock, we would have not been able to say, like, what is the catalyst for that to be under.
yeah, what
Versus
could
now,
be, right?
we're living the catalyst. The question is just the market thinks the catalyst won't last long enough for it to actually be a trigger, I think is
Yeah.
safe to say.
So again, I don't know that there's a call to be made from this other than an observation that, okay, this is an anomaly. And historically, any anomaly in those ratio or relationship charts never work out like, sideways. At some point, that relationship's going to break. And what causes it, to Justin's point, who knows? Could be oil. Moving on to our next section, domestic chart or domestic stocks. I am chart overloaded. I can't even not say the word. First chart in the domestic section is US stock benchmarks. It's off to a rough start to the year, and it's been a rough road, but it's really only its longest losing streak in a year.
Yeah. And it's kind of all come from March, right? So even though there's been multiple down weeks, we've yet to really see those big compounded down weeks, which even during the so-called Liberation Day sell-off, which was the last time this happened, they were deeper sell-offs, but it was equally as, in terms of duration.
Correct. The next chart looks at aggregate dealer gamma out 6 months. This is really high level structural stuff relating to the markets, but it's here because we think it's important. And basically, this is a critical area, the 6475 level of the S&P. But it kind of, from my standpoint, it sets us up for, if they're going to move higher, they're going to grind. And if they go lower, it could be an elevator down.
Yeah, that's a good way to look at it. This is one of those inputs that a lot of the terminology becomes kind of wonky and thus it sort of throws people off. But generally speaking, it's just this is a look at what options do to the market. And there's really two observations at present. One, to your point, we're in a so called negative gamma environment, which, if you look at drawdowns, the vast majority of those do occur within negative gamma, right? And on the inverse, most moves upward have positive gamma the whole time. But so negative gamma, and then as you see showcased right there in the red arrow, is there's a lot of downside protection sitting just below the market, which could very well explain why, at least for now, the market's sort of running down into those levels and really having trouble getting conviction to go through. Because to go through, participants are going to have to now sell that and assume and bet the market goes even lower and buy it lower, right?
Yeah, and we just had a massive option expiration,
We
which they
should
keep
know this
getting
pretty
bigger and
well.
bigger, right? They are becoming a bigger part of, from our standpoint, our observations. We have to know what the underlying options market structure looks like. Moving on, next chart looks at single stocks, their daily retail flows, and we've seen them peter out here, to your point, in the month of March.
Yeah, I know you'll remember Ryan, but we had some funny anecdotes of people trading individual stocks, going into what, fourth quarter of last year. And this just chart is basically showing retail appetite for individual stocks has kind of fallen off a cliff as a lot of those speculative names, hit a really tough time, not just in the recent sell-off, but if you recall, kind of going back to November. November was actually the top,
Yep.
a lot of the, super AI high flying stuff.
Yeah, the stuff that wasn't projected to have positive earnings for 5 or 10 years that people were just gobbling up, I guess it's back to lots of things work until they don't, and moves in the opposite direction can be just or more violent. Next chart looks at Mag 7. They've decoupled from the rest of the S&P 500 from a correlation standpoint, meaning the Mag 7, the biggest tech companies will oftentimes move in a different direction than the 493 other companies in the S&P 500.
Yep. So think of this kind of, you've got one stock market, but you've got a very interesting stock market in that the biggest seven companies are less or very different in terms of their economic sensitivity than about all the rest. So when the market and participants think that the real economy might be starting to pick up or outperform, usually during rate cut cycles, et cetera, you're going to see the Mag 7 might still perform well, but you're going to see some quick, sharp moves in things like small caps or industrials or materials. Versus when you go into kind of like a risk averse environment, but not a complete panic, as we've seen for many years, at least historically, investors have started to increasingly say, all right, well, the earnings of these biggest of big companies, I'll just hide out there for a period of time. So we think the recent underperformance of the Mag 7 on just AI CapEx worries might, might present an opportunity depending on the strategy and the approach.
Yeah, it's almost like they're viewed almost as safe havens by some investors. If they're going to own equities, I'm going to own these regardless of the macroeconomic environment
And the market hasn't
backdrop.
priced that yet, right? The market is currently not pricing that, which there thus could be the opportunity with some time horizon.
Next chart, it looks at a lot of stuff, but the takeaway is given the amount of headline concern and anxiety, we haven't necessarily seen that in price action yet. There's a disconnect between what people think is happening in the market and what's actually happening. If they just looked at news headlines and they where they thought the markets were, there's a disconnect there between the actual, price action. Is the question is it complacency, or are they underpricing, or investors in large underpricing the risk of this everything we've talked about? Or are they seeing through the headlines? But there's certainly not been capitulation at this point.
This was something I think you and I were talking about the other day, but what's interesting about the modern market structure, and you combine this back to derivatives being so big, we're in this sort of in between zone where it's neither complacent nor it's panicked. And the reason is because a previously complacent investor can now buy downside protection before they panic. You know,
Yeah, right.
record degrees, right? Which is why back to the other
There's a
chart.
stopping point between that absolute puke of
Right,
everything.
and it's if it's a complete total shock, alien invasion, investors are gonna skip that middle phase. But when it's the so-called taco, again, investors
Yeah.
spend 1% or whatever the percentage may be to really lose that, but protect my portfolio if we crash. But I'm not gonna sell my underlying stocks just so that I get a tweet at 4:05 PM, which, by the way, it's happened twice now. We're getting the deals in the aftermarket hours.
Yeah, wicked volatility in the futures markets. Yeah. Moving on to our next section, looking at ex-US markets. This just looks at an aggregate US dollar stance, and there was a substantial bet against the dollar that has been backed off slightly, but still.
Yeah, this chart's really interesting. As we've been discussing and, positioned for in various of our strategies, the US dollar has really just been at best case, it weakens slowly. At worst case, it might rally and then weaken a lot again, meaning that there's been an increasing appetite for non US assets that really has grown bigger and bigger and bigger, albeit with ebbs and flows for what? At least 5 quarters now, going on 5, 6
Yeah.
quarters, depending on how you measure it. And it came from a low starting point, right? When we came into 2025, there had been 13 straight years emerging markets had underperformed the US, which is wild
Yeah.
when you think about it.
Yeah, talk about anomalies, right? Rarely working out sideways,
Talk about yeah,
it's
and if it
been
goes the other way, I mean, talk about big cycles. We're talking like more than decade cycles of which would also make sense because it's not a quick decision to move a bunch of money to other parts of the world when you're looking at, the big picture of it all. Anyway,
yep.
so you have got this to say that to your point, speculators in this particular instrument were net short. Obviously, this is like the dollar index, so each currency is different, but they very quickly reduce those and risk off. Basically, they need to sell things down. What's interesting at this point is we've not seen any material shift to where global investors are hedging their portfolio by going long dollars speculatively. So this is kind of a
Yet,
yet
which really surprised going into
$670
the
bear
next
case. Yeah.
yeah, going into the next chart, right? That could be the next leg on the international front is this next chart looks at net energy importers as a percentage of their energy use, but then also as a percentage of their GDP, right? And what you'll see is some of the better performing international markets near the top of this over that last 5 quarter mark. And then you've seen some violent down moves. And again, some of those same countries or areas since the Iranian conflict began.
But similar to, what we're saying on US stocks, Japan, Korea, those markets are still pretty high flying. Chile, if you go back long enough, if the market is not going to look through this, one would think those are some potential areas of, quite a bit of capital could want to reverse out having come in. But it'll be a big test because it's really just going to kind of show the marketplace how committed the most recent round of big money into international stocks is. Was it your big pension funds, all over the world, including in the US, doing it for a few percent over the past year because they had become underweight? Or was it really just a bunch of momentum? And
Money, yeah. Yeah, was it a core allocation, a rebalancing, or, was it, like you said, hot money,
you
momentum?
never know, right? You know.
After the fact, and then, we can talk about the call we made for 10 years, but it's
Been writing about
often,
it.
I mean,
You've been writing
so many
about it.
books,
You've written some
so
things.
many, so many books have been written about big calls that aren't reflected in actual strategy allocation, but that's neither
Ryan
here nor
scribbles
there.
on a chalkboard these calls.
Yeah, easy to erase, right? And then I take daily pictures of it for proof. Moving on to the next section, interest rates. This just looks at monthly returns for broad-based U.S. Treasury index. And as we see here, there was quite a bit of pain in March thus far.
Oh yeah, I mean, February, what? Big up move in global bonds, money made on yield as well as appreciation of capital. People were increasing their bets on a rate hike, expecting two, or excuse me, a cut, expecting two cuts versus now oil shock, huge down week in treasuries. And then I'm going to steal your thunder and shift us to the next chart. The bets on rate cuts, which are below the dotted line or the black horizontal line, immediately now the market's thinking it's not impossible to think that we could get a hike.
Yeah, and I mean, this is an interesting aspect of the Federal Reserve that it's got a dual mandate, right? Labor market and inflation price stabilization. Because if the labor market weakens substantially, you'll see this go right back down. But you take the Eurozone, for instance, that has a single mandate on price inflation. I mean, their probability of hiking is almost locked in for a rate cut at this point.
And it's interesting when one thinks about it like that. A lot of central banks actually don't look to influence the labor market. They do it through inflation, meaning that they'll hold out with high interest rates until the labor market breaks. And then when that slows inflation, then they'll cut rates, which is
Right.
why
It's very unique to the Fed.
which is exactly which makes market participants in U.S. interest rates have to be more speculative to some extent versus a lot of these other, we're seeing it now in Japan. When they finally do start moving, they really just do move on like slow moving. I things versus the Fed, as we're seeing. Look how quickly that can get tossed around because you have to try to handicap politics in it as well.
Moving on to the next chart, looks at the move in interest rates. It's now on the 2-year yield. It's now above the Fed funds rate, which, as this chart shows, is a rarity.
It's a rarity and it almost never lasts because, as I think we've talked about, more so than not, the Fed just does what the market expects, assuming the market has expected it for not a very brief amount of time. So that doesn't mean that because right now the market thinks there could be a hike, the Fed's going to have to hike because of that. But if those expectations continue to rise and stay, then likely the Fed will hike. And that's really what happened in 2022. It was that the fact that the market expected that to mean revert, but really the Fed started catching up those expectations, and then the equity market, got that later.
Yeah, and I mean,
Or is it complacency? Back to the is it complacency?
yeah, it's a violent reversal to the narrative. It was a crowded trade. The Fed was cutting, right, and this is a massive reversal. But what does it mean? It's an immediate headwind to equity valuations, right, and it's a possible change in risk premiums. What people are willing to pay per dollar of earnings, and it's back to the oil and gasoline and diesel charts. How long does it stay elevated to turn? I mean, it's going to spill through to all this other stuff we're talking about here. The lasting impact. Does the Fed cut? Does the labor market weaken? It all comes back a lot to, what'd you say? Oil is everything. Oil is in every market.
For now.
Next chart looks at the MOVE index, which is the bond volatility index, and we've back to everything we've talked about, because of a sharp, quick move higher in yields, the volatility of the bond market has went up.
So as you can see in this chart, if you wanted to bet that volatility is going to have to drop back down, all of these marks, including the one that happened last week, would have been a good time to do that, right? The difference is that, the outlook for interest rates is very different during those different times. So in 2022, after this happened, the bond market actually saw rates rise pretty substantially, like the Fed actually hiked rates. Now, if you think that not only is this volatility going to be short lived, but the Fed is not going to hike rates, this could be a very interesting time to reposition one's outlook on bonds, treasuries.
And last chart in rates is a chart looking at the real rates for the United States, France, the UK, and Japan. And again, back to the month of March, we've seen some pretty significant rising real rates there.
Yeah, they definitely jumped, but I think this chart also shows the fact that those lines were that low. It shows that even though rates were higher than they were, 10 years ago, financial conditions were actually very loose up until this rise in rates, spike in oil. So I think the big theme maybe of what we're talking about is, will these tighter financial conditions last longer than a few weeks or a quarter? And if so, the outlook for all risk assets is going to actually become fundamentally very different than it was coming into this year.
Because rising real rates that stay elevated is basically a insert a sharp breaking sound on all economic
The
momentum.
multiple
Yeah, I mean, you're talking not just at the equity level, the discounting future earnings, et cetera, but it tightens, corporate and consumer spending. This hurts existing bondholders, but to your previous point, it could create an opportunity for new money or repositioning. Again, if it stays, and back to everything we've been talking about, that's a lot of ifs, right? Because it appears the market's kind of looking through that to a taco, to a change. Last section, looking at commodities. First chart just looks at the volatility of gold relative to the equity market VIX, and both have been elevated, but gold's been much higher.
Yeah, it's pretty wild to look at this chart. Gold, 1 month implied volatility being the yellow line, and just realizing how much more volatile gold has become here in the last, year or so compared to what it's been before that in both directions.
Right. Yeah. And what could this chart mean is underlying macroeconomic stress, right? It could symbolize that. And it could also symbolize that there's a lot of new market participants in the gold market that haven't been there. A lot of money's chased
Yeah,
gold.
that's actually a good point. There was a bunch of articles that came out, I guess, at the beginning of this year where people that track flows had identified that not only is there like the ability for Chinese retail, Korean retail to buy, some instrument that makes its way into the gold market, basically pushing the price of gold or pushing it down. There's actually like these fairly large outside of the US stablecoin markets that allow you to buy and sell gold on leverage.
Yeah, I mean,
Gotta add
let's not forget
If
leverage.
we're talking
Yeah.
about the world today, no matter the subject, you must add leverage.
Yes. Let's take big moves and make them bigger. Next chart just look is a daily chart of the price of gold, and again reflecting on the previous one. When volatility is elevated, the price moves, the chart of the actual underlying asset's going to be all over the place. And there's some massive moves here from a historical standpoint in the price of gold.
It's just if it wasn't very remarkable how much gold went up in 3 or 4 months, it's even more remarkable how much it's now come back, you know?
Yeah, if you told me what gold would be worth and how much it'd move in a 2-month, 3-month period 10 years ago, I would have told you you're on drugs.
Yeah.
I mean,
But yeah, but
it's
here's the interesting point on that. This is something I wanted to mention to you. We'll say it here for the audience. Is throughout you and I's career, based on our age, we saw some gold volatility, after the financial crisis, but nothing compared to this. And I can speak for myself because we didn't trade through like the 70s and 80s, which a lot of people that really started trading gold did. I think we underappreciated how much gold could move just because it never had in our lifetime versus I feel like people that
right.
were in their 50s and
Recency
60s who
bias.
had traded, yeah, they saw the last time like gold totally went crazy in both directions, which
Good point. Last chart is looking at WTI crude oil. Obviously, it's been pretty volatile and it went up a lot, it came down, and it's grinded back higher.
so near term, I think it's pretty clear here. The key is will the oil market take out those highs that happened, on the initial trading of the weekend where the invasion or, the what is it called? An excursion. When the excursion started. That's what they're calling it. Excursion's like what I might do when I go into a different part of town looking for lunch, you know?
Yeah.
Anyway,
Whatever.
a key mark is will oil surpass those levels or was that the top? Because a lot of times when these shocks happen, the top is interestingly, shout out to Brent Donnelly for calling this out, but it's remarkable historically if you're looking like at not the stock market, but you're looking at like commodities or currencies, etc., how much the top on news flow usually happens at that Sunday night, Asian Monday morning open, you know, and if, in fact, we don't make new highs in oil, that will be the case here.
If it does, meaning the flow, the supply of oil fixes itself, then everything we talked about will probably resolve itself to the upside, all things being equal, right? Labor market doesn't weaken substantially. There's not some other real big credit shock or inflationary shock. But if it does take out those highs or even trade at them for an extended period of time, then there's probably going to be some carnage economically and in the asset markets. But
Accumulated.
yeah. But anyways, that's went a little longer than normal this time, but really an exciting time for us as chart voyeurs, always looking at it and talking about it. But again, if you have any questions, you want to talk about any particular topic in greater detail, reach out to us at info@solinda.com, info@sollinda.com. If you're an advisor, just unhappy where you're at with your partnership, give us a call. If we can't help you, I know a lot of people that will still take my phone calls, believe it or not, that I'll try and get you in touch with someone that might be able to help you. But we'll be back again in 2 weeks. Appreciate you tuning in.